The tax laws changed, the Roth conversion rules did not. That one sentence trips up a lot of smart people, so let me say it plainly before we go any further. The One Big Beautiful Bill Act was signed into law on July 4th, 2025. It made today's income tax rates permanent, but it did not close the door on Roth conversions, and it did not rewrite how they work. So if you've been sitting on the should I convert decision, waiting to find out whether the rules survive, they did. What changed is the math around the conversion. And in 23 years of doing this, that's the part that decides whether a conversion helps you or quietly costs you. Stick with me and I'll show you exactly what still works, what OBBBA moved, what the One Big Beautiful Bill Act moved, and the 5 places a conversion can cost you more than your tax bracket says it should. I'm Cody, I'm a CPA and a certified tax coach. On this channel, we turn tax law into decisions you can actually use. If that's why you're here, hit subscribe so this shows up when the rules move again, because they will. Now let's get into it. Did the One Big Beautiful Act change the Roth conversion rules? Shorter answer is no. The core mechanics are the same as they were. A conversion moves money out of a pre-tax retirement account, a traditional, a SEP, or a simple IRA into a Roth. You include the taxable portion in your income in that year. In exchange, that money grows inside the Roth and qualified withdrawals come out tax-free later on. But there are 3 things you should lock in. 1, there is no income limit on doing a conversion. There used to be a $100,000 limit, but that's been gone since 2010. Income does not stop a conversion. But just know that direct Roth contributions still have their income limitations. Conversions and contributions are different animals. 2, it's a one-way door. Federal law no longer lets you undo a completed conversion. That recharacterization move unwinded itself in April, was unlimited for conversions after 2017. So you can't wait until you see the finished return and decide you converted too much. That's exactly why sizing it right the first time matters. And 3, there are a few real exceptions, and these are not One Big Beautiful Bill changes. They've always been true. Your required minimum distribution can't be converted. It has to come out first. So if you're older, you must take your money out, then you can convert some other money. A simple IRA has a 2-year wait before converting, and a non-spouse who inherits an IRA generally cannot convert it. So anyone, any amount is gone. The honest version is most owners, most eligible balances, with a few real exceptions. The pro-rata rule. So here's one that surprises people, so stay with me, because this is where the backdoor Roth blows up. If you've made non-deductible contributions to a traditional IRA, you already pay tax on those dollars, so part of your conversion should come out tax-free. And that's true. But you don't just get to point at one account and say, I'm only converting this after-tax money. Form 8606 runs what we call a pro-rata calculation. It adds up all your traditional SEP and simple IRAs, uses the combined year-end value, and spreads your after-tax base proportionally across everything. Translation: if most of your IRA money is pre-tax, most of your conversion is taxable, even the piece you thought was clean. And that's the single biggest reason a backdoor Roth produces a surprise tax bill. So what did the One Big Beautiful Bill actually change for agency owners? It changed the math. The mechanics held, but here's what it moved. And the theme for this whole section is one idea. What matters is your real marginal rate, not the number printed on a bracket table somewhere. Those are not always the same, and here's why. The 2026 rate sunset is gone, and that's good news. Before the One Big Beautiful Act, the 2017 tax rate was set to expire after 2025, and that created a deadline. Convert now before rates jump. That deadline is gone because the One Big Beautiful Act made the 7 brackets, 10 through 37, permanent. The dollar amounts inside them still adjust each year, but the reversion is off the table. So the posture changes. Conversion planning goes back to what it should always have been. A deliberate, multi-year exercise in filling up your lower brackets on purpose, not a race to beat one sunset. But, and write this down, the clock is gone applies to the rate sunset only. Other Big Beautiful Bill Act provisions still apply. And you know I have a problem saying that big word. So timing hasn't stopped mattering. And here's where it bites. There's something new for senior citizens called the senior deduction, and that expires in 2028. It created a new deduction for older taxpayers, and a conversion can meet right into it. Now, Obviously, this will not affect a lot of agency owners, but it can affect those that are in the process of selling. For 2025 through 2028, if you're 65 or older, you could claim up to a $6,000 extra per qualified person, so a couple would be $12,000 in extra deduction. But it phases out once your modified adjusted gross income passes $75,000 for a single person or $150,000 on a joint return. Once again, the agency owners, this is not really going to matter to, but it may matter to your parents, it may matter to somebody else. Run a conversion through that phase out and it can cost you twice, the tax on a conversion plus the tax on the deduction you lost. And I want to be precise because precision is the whole game here. Losing $1 of deduction doesn't cost you $1, it adds $1 to your taxable income, and the real cost is the dollar taxed at your marginal rate. Either way, a conversion that looks like it's sitting in the 12 or 22% bracket can carry a much higher effective cost than it looks. And remember, this deduction is temporary, so under current law, it's gone after 2028. Here's one that comes more into play with the agency owners: the SALT cap or state and local tax cap phase down. This reverts back to what it was, $10,000 in 2030. The One Big Beautiful Act raised the cap on deducting state and local taxes, but it added a phase down at higher incomes. For 2026, the SALT cap is $40,000. It's actually $40,400. And it starts phasing down once your modified adjusted gross income passes $505,000. And it'll phase all the way down to $10,000 depending on your income. But here's the part that people miss. This only bites you if you're itemizing and your state and local taxes are actually high enough to be limited by the cap. If you take the standard deduction, losing part of that theoretical SALT cap costs you nothing. And why many of you will be in this boat is if you take the pass-through entity tax deduction, meaning you pay your state taxes in the state you're allowed, at the entity level, you get the deduction off of your federal income and you get a credit for that tax on your personal return. And then you get the full itemized or standard deduction. But if all three line up, back to the beginning, but if all three line up, you itemize, your SALT is capped, and your income lands in that corridor, then conversion income shrinks the deduction and raises your taxable income at the same time. And that combination is going to push your real marginal cost well above the stated bracket. And remember, the higher cap is only temporary. It reverts back to $10,000 in 2030. Don't make the mistake of not taking the pass-through entity tax deduction and making those payments if you can in your state. The point across all of this is the same. The right question is never what bracket am I in? It's what happens to my total tax bill, federal and state, when I add the next dollar of conversion income. Does the backdoor Roth still work? Yes, it does. For higher earners, the backdoor Roth is still on the table. The One Big Beautiful Bill did not touch it. The move is the same. Make a non-deductible traditional IRA contribution, then convert it. But remember the pro-rata rule. If you're holding other pre-tax money in traditional IRAs, SEP, or simple IRAs, Form 8606 treats it all as one pool, so part of your conversion is taxable, even though the contribution you just made was after tax. One useful distinction is a pre-tax 401k is not part of the IRA pool, so it doesn't dilute the math. But roll that 401k into a traditional IRA and it becomes part of the pool. So check that before you assume a backdoor Roth is clean. So who is this for? Straight talk because you've earned it. A conversion is not automatically right just because the rules survive. A big conversion can be a poor fit if it burns through a lot of things, pushes you over a senior deduction, knocks out an ACA credit, trips the SALT phase down, or drags your investment income into the 3.8% tax, all without a real expectation that your rate will be higher later. But even then, don't convert usually isn't the only answer. It might be a smaller conversion, stopping just below a costly threshold, spreading it over several years, pairing it with charitable giving, or waiting for a genuine low-income window. And sometimes the right amount is zero. The tool is powerful, it's just not universal. It helps most people who can pay tax at a genuinely lower rate today than they pay later, and even for them, the amount is a calculation, not a hunch. So where does that leave you in 2026? The old rate sunset is no longer driving this, but timing still matters. The highest SALT cap runs out after 2029, and every year that passes is one fewer years to convert before your RMDs begin. If a conversion is on your radar, the next step is to run the numbers against your actual income picture, not just your bracket, because that's the model that gives you a defensible number instead of a guess. We look at the whole board before we recommend a single dollar of conversion. If you found this helpful, come back for more. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got two things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.